Hey, what's up guys? Crypto Numpty back for the second video on the channel. Hope you enjoyed the introduction. It was just a basic overview of charting and how to get into cryptocurrency trading. In this video, what I want to do is I want to just go through the market terminology, or some of the terminology that's used, and get you used to looking at candlestick charts like this one here. We can also use some of the charting tools to start drawing lines and making fancy patterns on here to give ourselves a better understanding of whether we should buy and whether we should sell. I'll also go through some quite good resources on understanding how to read the candles, what the candles represent, and how you can use those to your advantage when it comes to building your strategy. So to get us started, I'm just going to try and explain in my own way what a bull market is and a bear market is. There's actually three descriptions for trading markets in my view. That is a bull market, a bear market, and a ranging market. A bull market is going up, a bear market is going down, a ranging market is not doing anything. So why do we call it bull and bear market? Well, if you think about bulls, when they attack something, they lower their heads, they run in for the attack, then they raise their horns. Conversely, bears, what they do when they attack, they stand on their hind legs, and then they force themselves down onto whatever it is they're attacking. And that's what financial trading, from my experience and my knowledge, is all about. It's about the bulls attacking the bears, and then the bears come back and attack the bulls. So when you start reading through some of the news articles, you'll read about bullish markets, bearish markets, and the bears attacking the bulls. So it's not actually going on. They're not real bears attacking bulls and not real bulls attacking bears. It's just a phraseology, a terminology to describe how the market's performing. And when we look at charts like this, it makes more sense, and we can see it more clearly when the market is bullish and the market is bearish. So we can see if a market's going up, it's bullish. If a market's going down, it's bearish. And this is where they use those phrases, those terminologies to describe this movement in the price fluctuation within the market. The other one we discussed was ranging, when the market isn't doing anything. And I've chose Ripple Bitcoin pairing to describe it, because we have a very good example of a ranging market right here. So we can see that the price fluctuation during this time period didn't do anything. It went up and down slightly, but on the whole volatility was very, very low. There was no movement within the market, so it was just ranging. And that's the expression used to describe. Now, I'll be perfectly honest, when I started reading up about this and started reading how to look at candles, look at charts, understand the market, I was like, what does all this mean? Bulls and bears and ranging. But actually, if you try and take a step back from the terminology and the phrasing, just accept them as how things are described, it becomes very much easier to go through reading news articles about bullish and bearish markets and when something's ranging. So yeah, that's pretty much a very quick overview of a bullish and bearish and ranging market. So we can see a ranging market there. There's a little bit of a pump, it then ranged, the market was ranging again, fluctuated a little bit there. It was then very bullish. This peak here happened in a very short space of time. So between, this was a 2-hour period. On the 21st of September 2018, where the market went up significantly but then dropped significantly as well. So over that 2-hour period, you could have made quite a bit, or you could have lost quite a bit if you bought in here. In terms of how to describe the market, I've seen some YouTube videos, and again, I'm not sort of trying to make out I'm an expert in how to read markets, but my understanding of how to read a market is not when you drill down into the 5-minute and the 1-minute candles. It's actually, you need to take a step back. You need to start looking at the broader scope or the broader range of the market. So, if we zoom out and zoom out and zoom out and we can adjust resolutions of the market, but we can see that this is a very bearish market. the market drops. We've got these peaks and troughs, which for me as a day trader, this is what I'm looking at. I'm looking at trading within these peaks and troughs. But for long-term strategy, long-term trading, you look at this market, you can see that the market is undeniably, it's going down. And after it went down so much, I'll just change that colour a little bit. Let's make it a blue. No, that doesn't make it any better either, does it? Let's make it a red. There we go. So yeah, this is a bearish market, undeniably, and it's, if you read all of the news articles and you listen to people describing the Ripple Bitcoin market, they will tell you that it's a bearish market for this year so far, and it's shown in the charts. You can go all the way back to May. The line continues through. There's a continuation of that line through, but inevitably the line is still going down. It's not ranging. Even back through to February again, if we extrapolate that through, and I'm generalizing here quite a lot, but we can see that the market is still going down. So that's how to read a market. That's how to understand what a market is doing overall. And you need to do that when you're managing your risk, because obviously you want to take as little risk as possible. You want to make sure that you're not going to invest in something that eventually is going to continue going down and continue going down until the point where it's going to be worthless. The same when you're reading a bullish market. It's always wise to try and drill out to as far as you can and understand where the market's going for the future. I've just pulled up on CryptoWatch here the Bitcoin USD market, and you can see way back in October, or pretty much all of 2016, you can see that the value of a Bitcoin against the US dollar was 686. So it was around $600 to $1,000. That was the value of it, of a Bitcoin. If you bought then, you can see this very bullish market over this time period, over that year 2017. The price actually peaked out at 20,000 US dollars, I think. Again, that's over a year, so depending on how many Bitcoins you owned at this point in time would depend on how much profit you would make at this point in time. So as long as you apply these basics to your risk management strategy for when you're trading, it should be quite easy for you to manage the risk and make sure that you're putting yourself at low risk when you do start trading, when you do start committing your funds into buying something, because one day Bitcoin might not be the big one. It might be Ethereum, it might be Ripple, it might be one of the other altcoins, and if that's the case, you need to monitor that. I know at the moment there's a battle going on between Ripple and Ethereum for this second place. You can see that the market cap there, they're quite close to each other, and I think it was a couple of days ago where XRP, or Ripple as it's known, actually overtook Ethereum, so that became the second big thing below Bitcoin. So that's why we need to watch the markets. We need to make sure that we understand if the market is bullish or bearish, or if it's ranging. Typically if it's ranging, it means that for this particular coin, for Ripple, there's no news that's come out about Ripple. There's no interest in Ripple, so people are just holding on to their coins. They're not selling, they're not buying, they're just waiting the market out. And they're waiting for something like this to happen. They're waiting for the market to either start rising in a bullish pattern or start falling in a bearish pattern. If it starts falling, they start to sell. More people start to get rid of their Ripple coins, and the market starts dropping. Okay, lastly, I'm going to go through a quick introduction to candlesticks. If you go to stockcharts.com and go to the school there, you can actually bring up a school or an introduction to candlesticks. It goes through all of the history used to trade rice in the 17th century, which I think is absolutely fantastic. But it does go through what a formation of a candle is. So you have the upper wick and the lower wick, or the upper and lower shadow, and then you have the body of the candle. On this particular website, they're black and white, but on the charts that you're looking at there are red and green, so that's pretty much self-explanatory anyway. Basic makeup of a candle, so you've got the body of the candle. For a green candle, or in this case a white candle, the open is below the closed, so any candle that you're looking at is for a given time period. Now this could be 1 day equals 1 candle, or this could be 1 minute equals 1 candle. It all depends on this resolution that you set on your chart. So at the moment, each one of these candles represents 3 days. So that is a 3-day candle. If I change the resolution right down to 1 minute, then each candle here now represents a minute. And what it also does is it also tells you what happened to the price in that minute. Now if you are going for the long trading strategy and you think, well, I'm going to invest over a longer period of time, you need to set this resolution a lot higher than the minute. If you set it to the 3-day candle, then that's pretty much 6 months, 7-8 months of data there. And you can see the market is bearish, so if you were investing, you need to start looking at your support and resistance lines, which I'll cover in another video, and decide when you're going to opt in to buy or trade. If you're day trading like myself, I like to use the 30-minute candles. This gives me half-an-hour increments, which allows me to view the market more minutely. We can still see we're in a bearish market, but what I'm doing is I'm trading on these dips, on these peaks and troughs, and buying when it's low and selling when it's high. That's how I use the charts for day trading. So again, just going back to the candles, we can see that for a green candle, or in this case a white candle, the close was higher than the open, so it closed at a higher price than it was when it opened. And the opposite for the red candles, it closed at a lower price than when it opened. The wicks or the shadows are self-explanatory as well. The shadows display the maximum and minimum price that stock obtained during that time period. So even though it opened and closed, at some stage it might have gone a little bit higher but then dropped back down again because the sellers came in and pushed the price back down to this close price. And the same here, the lowest price, the minimum price that it reached during that time period, and then the sellers came in and sort of took that out. Also, you get different size candles as well. It's quite easy to look at that and say, well, they're both the same size, it's quite easy, but that would be too simple. If the stocks were trading like that, where the candle sizes were the same, where there wasn't any fluctuation, then we'd start seeing this ranging pattern here, where they don't rise, they don't fall, they just stay, and most of the candle sizes are going to be pretty much the same size, which you can see quite clearly. Okay, so they are a little bit different, but not this different. You can see the candle sizes here are a lot more pronounced. So we can see the various explanations of the sizes of candles, the different patterns in the candles as well. So we've got a longer upper shadow, a long lower shadow. We've got the spinning tops, which again is indicative of a ranging market. So if you had a whole row of those, you can see that nothing went up, nothing went down. They both open and close at the same price, so they cancel each other out. Doji is exactly the same as well. A doji is a good signal, particularly at the top of a buy or a sell, particularly at the top of a peak or at the lower of a trough. The doji for me is representative of a rejection. So if you have a whole trail of red candles here and the market's dropping, and then you spy a doji, that represents rejection in the price going lower, and in all likelihood the price is going to increase. And we can actually see that in some of the charts as well. So if we go over here, we can see quite clearly there, and we can see that on some of the charts here. So if we just look in at some of these prices here, we can see that the price tried to reduce there, We see this red doji here, which is a rejection of a lower price than this candle, and it's the market's way of saying no, we are not going to sell for any lower than that. And then afterwards the market started increasing. Doesn't happen all the time, but again, when you look at these indicators, you have to take them with a pinch of salt. And as part of your learning experience, as was part of my learning experience, when I started reading about candlesticks and dojis and all this new language, I actually went over to the charts to see if I could find examples of this happening in real time. You know, I didn't just want to take their word for it. I wanted to make sure that I could see this in real time and apply it to the charts. This was before I'd invested any money, changed any funds, and opened any exchange. So if you take your time to go through the various candles and what they represent, one thing I would say is don't take these as gospel. They are just a representation. They are an indicator, as with anything else. And with the stock markets, it's not just about reading one indicator and saying, right, I'm going to buy or I'm going to sell. It's all about trying to put all of these indications together to minimize your risk, and say, okay, so I've seen this candlestick pattern, these indicators are showing me that the market's doing this, therefore I've minimized the risk as much as possible. I'm going to place a trade and hopefully make a profit. Sometimes you'll get it wrong, particularly for me starting out. I did make wrong predictions, I did lose money, and only through doing this, again, I've only been doing this for 6 weeks, but doing it day to day over 6 weeks, you start getting a feel for it, you start getting in touch with what the market's doing. Okay guys, hope you like the video. If you do, just click the like button, subscribe, share away. I'm going to put up the next video, which is going to be explaining some of the indicators that you can look at, which when you combine it with what you've learnt about candles, once you've read through all this, it will give you a better indication of what you can expect and how to start reading the markets and knowing when the market is likely to go up or when the market is likely to fall. Okay, thanks, I'll see you soon.